Prepare for low stock returns, my friends. I just can't make the case that the markets are going to be great. I just can't. That doesn't mean they're going to be bad. It doesn't mean we're going to go bankrupt. It just, I don't. All right, it's going to be bad. Yeah, bad. Relative to what I think some of you, if not a lot of you guys, are anticipating. You got to prepare for low rates of returns. Well, let's just go to the numbers. This is doesn't mean you gotta be depressed. The evidence is so overwhelming that the markets will not give us good rates of return, what you're coming to expect in terms of the past. And I just wonder how many people fall, because I know they fall for the small cap value thing. And I've talked about that, because of Jeremy Siegel's book. I got back there a couple of different editions where he talks about, which is very interesting, out of the way, where he talks about from basically 1976 to 1983. You take out that 7-year time frame, there is no small cap value premium. There isn't any. The irony of all that is Jeremy Siegel, who had written that in Stocks for the Long Term in his book, he's going to get not chastised, but called out a little bit in what I'm getting ready to share with you, which is pretty interesting. It's a great article. And initially, I discounted this article because I just did. But all right, so let's check this out. Going back to the modern era, what's that? I don't know. But usually we think about the modern era of 1926. But the history of the stock market going back to basically 1800. So we got 220 years. All right. This is net of inflation, by the way. The stocks, actually, is this net of inflation? Net of inflation. All right. So we're going to go back to 1800. We got stocks 20-year analyzed, stocks 30-year analyzed, stocks 50-year analyzed. All right. And what you're going to see here is the light blue is 20-year analyzed. All right, so we're going to see that. This is what I want to focus on here: the not dark blue, but whatever that is, the darker blue, not the darkest, but the darker blue. And you can see we're going to look at 8% right here. And a couple times in the early parts of the stock market era, we had over 10% a year on analyzed 20 years. We didn't get to an annualized over 8% until 1890s or so. And we didn't get back, we hit right there in 1953, and we didn't get back until about 1965. But you can see, very rarely on a 30-year time frame do we ever annualize over 8%. Very, very rarely. Isn't that interesting? Right here, this is the phenomenon. So Jeremy Siegel talks about stocks in the long run, and rightly so. But while he also diminished the small cap value thing, and rightly so, but the reason stocks in the long run is because we have this time frame right there. Isn't that nuts? The post-war from 1942 on, we had basically a 40-year run where stocks demolished bonds, and that makes everyone think the stocks are the long run. I'll put a link in the show notes to this paper. It's fundamental. If you're not reading this paper, you're wrong. If you're invested. Anyway, so you can see the darker blue, not the darkest, 20-year, 30-year time frames, right? 8% right there. Take away that time post-war. What the? And then you just got a couple years right here. This goes to 2019, by the way. All right, you got a couple years from 1982 to basically 2002. That's it, man. A couple years over here in the 1880s, a couple years here from the post-war, a couple years from basically the post-Reagan and Clinton boom, and that's it. All right, so what we're going to do now is we're going to go over here, and we're going to type in 1992 to 2021. That's 30 years. All right, we're going to use the S&P 500 as the Vanguard S&P 500 as our proxy. The red is, by the way, the long-term investment grade bonds. And we're going to adjust it for inflation because my man did that. And we're going to say, what did 10,000 start in 1992? What's it worth now? It's worth about $100,000. So we take our trusty calculator, 10,000 plus minus present value, zero payment, 100,000 future value, 30N, compute interest rate, 7.97. We're going to round that up to 8%. So the last 30 years, we have 8% rate of return. I mean, look, so over 30 years, the darker blue, hardly, just a couple years there. a couple years here, and just a couple years there, and that's it. That's it, man. And what happened after? Zoops, 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 zoops. I'm not expecting high rates of return. I'm going to talk more about this article and other constructs. I want to divide this up because it's critical. So I use for the SM, I use for stocks 6.5% rate of return going forward, but that's before inflation. All right, and I use what do I use? 5.5% for healthcare, 3% on real estate inflation, property tax, whatnot. I think I use a 2.5% general inflation. So basically a 3% total inflation. So if you're getting 6.5 on stocks, 3% total inflation, you're getting net 3.5 on my software, right capital. What I use. Other people like my man Dustin Tibbetts down there at Jazz Wealth, he might use something different. So just because it's the right capital doesn't mean it's all the same numbers. That's what I use. 6.5% rate of return on stocks minus roughly a 3% inflation, and you get a 3.5% net going forward. With a high standard deviation too, higher than what you've seen in 2008 and 1930. In terms of downside risk. And if you can survive my stuff, I think you're in pretty good shape. A net 3.5. Let's just go back to net's 3.5. So we got right here 3.5. Very rarely are we netting 3.5 at all for 30 years. In fact, since basically the dawn of the modern stock market, over a 30-year time frame, we've never netted 3.5 ever. So that's in terms of the worst case scenario. So that's pretty good. So if you can survive my stuff, you're pretty good. That's for sure. I look at the volatility of the 10-year. 10-year is a light blue. Anyway, so that's what I'm predicting. Expected 3.5% rate of return for stocks going forward. Real return, by the way. And I'm okay with that. And you should be too. All right. We'll see ya. Love to hear your thoughts.